What is project finance? Infrastructure, industrial ventures, and public service initiatives are often funded through a financial approach known as venture funding. In this method, the repayment of debts and the allocation of equity are reliant on the revenue stream generated by the undertaking. The project's assets, privileges, and stakes serve as secondary security, while the primary means of repayment is the project's revenue. This financing approach is appealing to private sector entities since it enables them to support substantial initiatives without impacting their financial statements. Key takeaways. Project finance pertains to the financing of infrastructure and similar long-term projects with significant capital requirements, often funded by the public. Project financing frequently employs a financial structure characterized by non-recourse or limited recourse arrangements. In the case of a non-recourse loan, the debtor cannot be pursued for additional payments beyond the seizure of the asset in question. Project debt is typically situated within a minority subsidiary with adequate holdings, and this debt is not included on the balance sheet of the respective shareholders, thereby keeping it off the books. How project finance works. As previously mentioned, the term project finance refers to the funding of long-term ventures, particularly in the industrial and infrastructure sectors. It is most commonly associated with entities such as oil and gas companies and the power industry. Additionally, it is employed for financing specific economic entities like special purpose vehicles, SPVs. The capital required for these projects is entirely dependent on projected cash flows. Various entities often serve as sponsors for project finance, including contractor sponsors. These sponsors offer subordinated or unsecured debt and/or equity. They play a crucial role in establishing and operating business units. Financial sponsors. These sponsors are typically investors seeking substantial returns on their investments. Industrial sponsors. These sponsors usually believe that the project aligns with their own business interests. Public sponsors. These sponsors encompass governmental bodies at various levels. The project finance structure for a build, operate, and transfer (BOT) project incorporates several essential components. Typically, project finance for BOT projects involves the use of an SPV. This entity's primary function is to oversee the project by subcontracting various aspects through construction and operations contracts. During the construction phase of new build projects, there is typically no revenue stream, and debt service only commences during the operational phase. Due to this, significant risks are assumed by parties involved during the construction phase. Generally, the sole source of revenue during this phase stems from an offtake agreement or power purchase agreement. As there is limited or no recourse to the project's sponsors, company shareholders are typically responsible up to the extent of their shareholdings. Notably, the project remains off the balance sheet for both the sponsors and the government. Off-balance sheet projects. Project debt is typically situated within a minority subsidiary with adequate holdings, and it is not consolidated on the balance sheet of the respective shareholders. This approach minimizes the project's impact on the existing debt and debt capacity of the shareholders, giving them greater flexibility to allocate their debt capacity to other investments. In some instances, the government may employ project financing as a means to keep project debt and liabilities off the balance sheet. This strategy is aimed at preserving fiscal space, which represents the government's ability to allocate funds beyond its existing investments in public services, such as healthcare, welfare, and education. The underlying theory is that robust economic growth can bolster government revenue through increased tax receipts from a larger workforce, enabling the government to enhance its spending on public services. Non-recourse project financing. In cases of loan default by a company, recourse financing grants lenders full access to shareholders' assets or cash flows. Conversely, project financing establishes the project company as a limited liability, special purpose vehicle, SPV. Consequently, lenders' claims are primarily or exclusively tied to the project's assets, such as completion and performance guarantees and bonds in the event of a default by the project company. An important consideration in non-recourse financing is whether situations could arise where lenders can seek recourse against some or all of the shareholders' assets. A deliberate breach by the shareholders might provide the lender with access to these assets. It's worth noting that applicable laws may restrict the extent to which shareholder liability can be limited. For example, liability related to personal injury or death is typically not eliminable. Non-recourse debt is characterized by substantial capital expenditures, CapEx, extended loan periods, and unpredictable revenue streams. Evaluating and approving these loans requires expertise in financial modeling and a deep understanding of the technical aspects involved. To prevent potential shortfalls, non-recourse loans often impose limits on loan-to-value (LTV) ratios, typically capped at 60%. Lenders also establish stricter credit standards for borrowers to reduce the risk of default. Due to their heightened risk profile, non-recourse loans generally carry higher interest rates compared to recourse loans. Recourse loans versus non-recourse loans. When two individuals seek to acquire substantial assets, such as a home, and one opts for a recourse loan, while the other chooses a non-recourse loan, the actions that a financial institution can take against each borrower differ. In both scenarios, the homes can serve as collateral, which means they can be repossessed if either borrower defaults. To recover their expenses in case of default, financial institutions can attempt to sell the homes and use the sale proceeds to pay off the corresponding debt. If the sale of the properties yields an amount less than what is owed, the financial institution can only pursue the borrower with the recourse loan. In contrast, the borrower with the non-recourse loan cannot be pursued for any additional payment beyond the seizure of the asset. Project finance versus corporate finance. Project finance and corporate finance are fundamental concepts in the realm of financing. Both of these financing methods utilize a combination of debt and equity to assist businesses in achieving their financial objectives. However, they possess distinct characteristics. Project finance can be highly capital-intensive and carries inherent risks, relying on the future cash flow of a specific project for repayment. Conversely, corporate finance centers around enhancing shareholder value through various strategies, including capital investment and taxation. In contrast to project financing, corporate financing grants shareholders an ownership stake in the company. Some key attributes of corporate financing encompass a company's capital structure, which pertains to how a company funds its operations and expansion. Dividend distribution, where dividends represent a portion of a company's profits and are dispersed to shareholders. The management of working capital, which involves the allocation of funds for a company's day-to-day operational needs. What is the role of project finance? Project finance serves as a method for companies to secure funding to exploit growth prospects. Typically designed for substantial, extended-term projects, it hinges on the project's cash flows to reimburse sponsors or investors. What are the risks associated with project finance? There are several risks linked to project finance, including volume risk, financial risk, and operational risk. Volume risk can arise from fluctuations in supply or demand, competition, or shifts in output prices. Financial risk is often driven by factors like inflation, foreign exchange fluctuations, and changes in interest rates. Operational risk is typically associated with a company's operational performance, as well as factors such as raw material costs and maintenance expenses, among others. Why do firms use project finance? Project finance provides a means for companies to secure funding for their extensive, long-term projects. This financing approach often employs a non-recourse or limited recourse financial framework. Companies with less robust financial standings are more inclined to opt for project finance to fulfill their funding requirements instead of attempting to independently raise capital. This holds particularly true for smaller enterprises and startups planning substantial projects. The bottom line. Companies require capital to initiate and expand their operations, and one method they can utilize for this purpose is project financing. This funding method enables businesses, even those lacking a robust financial track record, to secure capital for substantial, extended-term initiatives. Sponsors who invest in these projects receive their returns from the project's cash flows. In contrast, corporate finance, which carries lower risk, focuses on the objective of maximizing shareholder value.